Greetings to all our IMAPS clients and investors. Let me walk you through the latest changes made during the first week of January. 2025 has finished favoring major asset classes. We expect 2026 to be a year of late-cycle economic expansion, but not recession. Growth is slowing, but contraction is not the best case. The proprietary Insigneo Forefront Recessionary Indicator places U.S. recession odds at 15% over 6 months and 30% over 12 months. While growth will slow compared to 2024 and 2025, the base case remains continued expansion, with global GDP forecasts ranging from 2.6 to 3.2%. The investment stance is to stay invested, avoiding premature de-risking and maintaining benchmark exposure. The key risks to consider and monitor for the new year are the following: policy, inflation shocks, tariffs, energy, wage price spirals that could force renewed central bank tightening, downside risk from China, especially via trade, commodities, and confidence, a reversal in the AI capital expenditure, which could undermine the late-cycle rally narrative and concentrated valuations. Geopolitical risk coming from Venezuela, Greenland, Russia, Ukraine, Israel, and the Middle East. Despite geopolitical shocks, inflation volatility, and labor market cooling in 2025, equity indices reached new highs, powered by the AI narrative. We perceive a risk for investors not being modestly exposed to equities into a downturn, but rather missing a potential explosive final leg in a late-cycle rally. The US is expected to see a slower but near potential growth, with monetary policy shifting from easing to on hold. The EU and Japan will experience low but positive growth, supported by aging demographics and cautious central banks. China remains a structural drag, with expected growth of 4.4% due to property sector stress and constrained policy space. The shift away from China as a global growth engine is expected to benefit other emerging markets, especially in Asia and Latin America, which are attractive due to young demographics, improving policy frameworks, and supply chain diversification. Portfolio duration remains aligned with the benchmark, where, within the investment-grade space, we favor income generation, bottom-up corporate credit, and low correlation strategies as sources of alpha. Allocations have been calibrated to minimize idiosyncratic risk to achieve balanced exposure to debt issuance. On the high-yield front, we have added a manager to complement the current allocation, enhancing the risk-adjusted performance of the sleeve. Allocation to equities was marginally increased to position the portfolio for late-cycle expansion, increasing the allocation to European, Japanese, and US equities. Nevertheless, the additional exposure has a focus on risk-aware managers capable of controlling risk factors during times of volatility while benefiting from economic expansion. We hope you are well, and as always, please reach out to your financial advisor or investment professional with any questions you may have. Thank you.